$440 million. Gone. Not stolen, not lost in a crash, not the result of fraud or recession or a rogue trader making bad bets. Destroyed. In 45 minutes, by a single forgotten server running code that was supposed to be dead. On the morning of August 1st, 2012, a completely ordinary Wednesday, one of the most powerful trading firms on Wall Street ceased to exist before lunch. This is the story of Knight Capital Group and the 45 minutes that erased 17 years of work. To understand what happened that morning, you need to understand who Knight Capital was and how much they'd built. Founded in 1995 by Kenneth Pasternak and Walter Rackett, Knight Capital started as a small market maker. In simple terms, they sat in the middle of trades, buying from sellers, selling to buyers, and made a tiny profit on each transaction. The key word is tiny, but when you're executing millions of those transactions every single day, tiny adds up to enormous. By 2012, Knight Capital was handling approximately 11% of all U.S. equity trading volume. On a busy day, they were moving $21 billion through the market. They were one of the largest traders on the New York Stock Exchange, and most people had never heard of them. That invisibility was by design. Knight didn't manage your pension or run your mutual fund. They were the engine behind the engine, the infrastructure that made modern markets function. They had 1,400 employees, offices in New Jersey, New York, and London, 17 years of careful, consistent growth. And they had one thing that made it all possible: their technology. In June 2012, the New York Stock Exchange announced a new program called the Retail Liquidity Program, or RLP. The idea was to give small retail investors better pricing on their trades. Good intention, tight deadline. Knight Capital had 30 days to write new code, test it, and deploy it across their entire trading infrastructure. 30 days for a system that moved $21 billion a day. The engineers got to work. They built the new functionality and called it SMARS, the Smart Market Access Routing System. It needed to be deployed to 8 servers simultaneously on the morning the NYSE launched the program. Here's where the first crack appeared. To make the deployment easier, one engineer repurposed an old flag in the system, a configuration switch that had previously been used to activate an old function called PowerPeg. PowerPeg was a test tool from 2003, ancient by software standards. It had been decommissioned years earlier. The code was still sitting there, dormant, buried in the system, but nobody had deleted it, because nobody ever deletes old code when they're busy building new things. The engineer used the PowerPeg flag to activate the new SMARS code. Makes sense in isolation. The flag was unused, why not repurpose it? The problem, nobody documented this. Nobody wrote it down. Nobody told the deployment team what the flag now meant. On July 27th, the deployment team pushed the new code to 7 of the 8 servers. The 8th server was down for maintenance that day. They came back the next day, pushed to the 8th server, except they didn't activate the new SMARS code on that server. They forgot to flip the flag. The 8th server was running the old configuration, and on the 8th server, the PowerPeg flag was off, which meant the old PowerPeg code, the 2003 testing tool, was still live, waiting. Nobody noticed. The system passed testing. Everyone went home for the weekend. August 1st arrived. 9:30 a.m. The New York Stock Exchange opens. The Retail Liquidity Program goes live. Knight Capital's new system activates. 7 servers begin routing trades perfectly through SMARS exactly as designed. The 8th server wakes up, sees the RLP orders coming in, activates the only code it knows how to run, PowerPeg. PowerPeg was never built for real trading. It was a test tool. Its logic was simple and completely wrong for live markets. Buy at the current offer price, sell at the current bid price. In other words, buy high, sell low. Endlessly, automatically, at machine speed. And there was no off switch, because why would a test tool need one? Within seconds, the eighth server was firing off hundreds of orders per minute, then thousands. By 9:31 a.m., it was generating approximately 8,000 orders per minute across 154 different stocks. Prices started moving. Stocks that normally traded in narrow bands started spiking and crashing. Night USC surveillance teams watching the data thought they were seeing a technical glitch. They called Knight Capital's CEO, Thomas Joyce. He was at home, recovering from knee surgery. Inside Knight Capital's offices, engineers were staring at screens that made no sense. Orders were flowing out of the system faster than anyone had ever seen. But the error messages were confusing. The logs were unclear. Nobody could immediately identify which server was the problem or why. They started shutting down servers manually, one by one. But here's the nightmare. Every time they shut down a server, the remaining servers, including the broken eighth one, picked up the slack and increased their order flow to compensate. The system was designed to be resilient. It was resiliently destroying itself. 9:58 a.m., the NYSE sends Knight Capital a message. Something is wrong with your system. We're seeing abnormal trading patterns. Knight Capital's trading desk responds, "We're aware, we're investigating," but they still can't find the kill switch because there is no kill switch, not for this. 10:15 a.m., someone finally identifies the eighth server. They shut it down. The bleeding stops. The total damage, 4 million trades, 397 million shares, 154 stocks affected, $440 million. Gone. Knight Capital's stock had been trading at around $10 per share that morning. By the end of the day, it had dropped 75%. The company had roughly $365 million in cash reserves. The loss was $440 million. They were, in accounting terms, insolvent. Employees started updating their LinkedIn profiles before the markets closed. Over the next 48 hours, Knight Capital scrambled for a bailout. A consortium of investors, including Jefferies, TD Ameritrade, and Blackstone, agreed to inject $400 million in exchange for a controlling stake in the company. Thomas Joyce, the CEO, was out within months. The company was eventually sold to Getco in 2013, forming KCG Holdings. The Knight Capital name quietly disappeared. 17 years of work, one forgotten server, 45 minutes. Here's something to think about. The code that destroyed Knight Capital was 9 years old. It had been sitting in their system since 2003 through multiple engineers, multiple deployments, multiple audits. Nobody deleted it because nobody was sure what would happen if they did. And when you're moving $21 billion a day, uncertainty is paralyzing. The flag that triggered it was repurposed without documentation by an engineer working under a 30-day deadline, doing the logical thing with the information they had. The deployment checklist missed one server. One. No single person was incompetent. No single decision was obviously wrong. The disaster was the product of dozens of small, reasonable choices that compounded silently over years until the morning of August 1st, 2012, when they all detonated at once. This is how the world actually fails. Not with a villain, not with a catastrophic explosion, but with a forgotten flag, a missing step on a checklist, and a line of code from 2003 that should have been deleted years ago. The same kind of code is running your bank right now, your pension, your mortgage, the trading systems that determine the price of the stocks in your retirement fund. Most of the time, it works fine. Most of the time. If this story made you think differently about the software running the world, you're going to want to watch the cobol video next. That's the story of a programming language from 1959 that still processes $3 trillion every single day, and the army of retirement age programmers who are the only people left who understand it. It's right there. I'll see you in it. A software company lost $440 million in 45 minutes because of code written in 2003. Knight Capital was one of the biggest traders on Wall Street. On August 1st, 2012, they deployed new software to 8 servers, but accidentally left dead code active on one of them. That server started buying high and selling low, automatically, at machine speed, with no off switch. By the time engineers found and shut it down, the damage was done. $440 million. Gone.